hedge fund ETF is an exchange-traded fund that seeks to replicate the trading activity and investment strategy of a traditional hedge fund. Exchange-traded funds are essentially a pooled investment similar to a mutual fund, but with one key difference. While mutual fund transactions close out at the end of the trading day, ETFs can be traded all day long, just like stocks. Hedge fund ETFs may employ a number of tactics to mimic traditional hedge funds. Some try to use hedge fund strategies to try and create the same type of returns as a regular hedge fund. Others apply an indexing strategy to mimic the performance of a particular hedge fund index or benchmark. This is similar to how traditional index funds, which may track the S&P 500 or NASDAQ composite, operate to match the chosen benchmark's return profile. Finally, hedge fund ETFs can seek to match the returns of a hedge fund by investing in the same things the fund does. When a hedge fund publishes a quarterly report of its holdings, a hedge fund ETF can analyze holdings and make similar investments. This can be tricky, however, since these reports rarely offer insight into where a hedge fund plans to invest next. Hedge fund ETFs can offer two main advantages to investors. The first is accessibility. Traditional hedge funds are usually exclusive to higher net worth accredited investors. The other upside of hedge fund ETFs is the potential to generate above average returns in your portfolio. On the flip side, there are two major drawbacks. First, risk is an important factor since hedge fund ETFs can be more volatile than other types of ETFs or mutual funds. There are no guarantees of higher returns. The other potential drawback is cost. Every ETF has an expense ratio, which is what you'll pay to own the fund each year expressed as a percentage of assets. Since hedge fund strategies typically require active management, you may be looking at a higher expense ratio to invest in one of these ETFs.